All right. Okay. So as you all know, we are going to discuss retirement plans today. Okay. So that also includes 401k plans. So we are going to, this session is going to be in these four sections. In the first section, we will uh, talk about retirement plans in general, their overview, and then we will see how do they work. And then we will see how employer matches the contribution. And at the end, we will see the summary. Okay. Well, retirement plans are special accounts, specific accounts that are created for employees uh, to ensure that they have sufficient funds when they reach the retirement age. So now let's talk about how many different type of retirement plans we have in US, right? So there are main two categories. The one is individual retirement account or IRA. The second one is employer sponsored, right? So the second one is actually the one which is applicable for the employers, the companies, right? And the one on the left is actually applicable for individuals who don't want to avail the plan which is offered by their employer, but they still want to open a retirement account, so they can go for IRA type of retirement accounts. Okay. Now, on the IRA category, we have two subcategories. The first one is plans for individuals, and the second one is plans for people who are self-employed or who are small business owners. So the plans for individuals are traditional IRA, Roth IRA, and self-directed IRA. Whereas the plans for people who are self-employed or who are small business owners, these are the plans for them. SEP IRA, Simple IRA, and Solo 401k, right? Now, on the right, we have employer sponsored. There are three subcategories in that. The first one is employees who are working in private sector. The second one is employees who are working in public sector. And the third one is employees who are working for some non-profit organizations such as, NGOs, community hospitals, cooperative banks, etc. Right? Now, for the employees who are working in private sector, we have 401k. For those who are working in public sector, we have 457B. And those who are working in for non-profit organizations, we have 403B. Now, all these three plans are same in terms of how they work, right? How their structure is. It's just that we have named them differently because they are meant for different. They're meant for employees of different sectors. Okay. Now, for each of these plans, we have their Roth version, right? So these are traditional plans, and these are their Roth versions. Now, now you might have seen in the internet, right? There are like several retirement plans you might have seen on the internet, and you might have gotten confused because you wouldn't be able to distinguish as to which one is meant for what, whether they are different in terms of how they work or they are just different categorizations. So this is how they are different. Okay. So the first differentiation is based on for which sector of employees they are meant for, right? Now within each category, we have mainly two versions, right? Traditional and Roth, traditional and Roth, and so on, right? So we will focus on this branch in this session because in the context of WFR, since we are working for customers in these three sectors, right? We are not working for small business. I mean, I won't say small business owners, but this is not actually applicable to us. Okay, so we'll focus on this one, right? So we'll actually first distinguish what is the difference between a traditional plan and a Roth plan. Now, whether it is a 401k plan or 457, 403, we'll see that how they're different. But first, let's see what is the difference in terms of which the first one is traditional and the second one is Roth. Okay, so we have two uh, type of plans, traditional and Roth, right? Now, how they're different. So the main difference is that the traditional plans are based on pre-tax deductions. whereas the Roth plans are based on post-tax deduction. What does it mean? It means that the contribution for the traditional plan is taken away before the tax is deducted, whereas for the Roth, the contribution is taken away after the tax has been deducted. Okay, now this is important to understand actually how it works in terms of deduction, right? So let's say that we'll first see the pre-tax one, the traditional one, right? So let's say that employee has a monthly gross of $5,000. Okay, assuming that the employee falls into a 10% tax bracket in US, though there is no standard 10% tax bracket that exists in reality, but just for the sake of making this example a lot easier for you to understand. Okay, so let's the rate of tax that employee falls in is the 10%. Okay, so now what I'm saying here is that the 401k deduction will happen before the tax has been deducted, right? So now we have to calculate the 401k deduction on this gross. Now let's say this is the taxable gross for the employee. Okay, so now that let's say, and also let's assume that the employee wants to contribute 10% of his or her gross towards the traditional 401k. So how much it will come out? $500. 10% of this gross is $500, or you can say his monthly gross salary. Okay, so the 401k has been calculated, which is coming out as $500, right? Now the taxable gross remains as 4,500, right? After you take off the $500 from this gross, the taxable gross remains as 4,500, right? Now you have to calculate the tax on it. So the taxable gross is 4,500, and if employee falls in the 10% tax category, tax bracket, so how much will be the total tax on this taxable gross? $450, right? Then how much will be the net pay? It will be 4,050. Okay, so you see here the 401k deduction has happened before the tax has been deducted. Okay, so the net pay in this case is $4,050, $4,050. Now let's see how the post-tax deduction works. We'll take the same assumption, the same monthly gross as $5,000. Okay. Now in this case, I'm saying that the first the tax will be deducted and then the 401k deduction will happen, right? So again, the employee is in the 10% tax bracket. So how much tax will be on this $5,000? $500, right? The tax will be $500. So the pay after tax will be 4,500, right? Now we have to calculate the 401k deduction amount. Now let's again assume that the employee is contributing 10% of his gross. Okay, so the 10% of this amount will be 500. So still the 401k deduction will be calculated based on the gross. Okay, so it comes out as $500. Now what will be the net pay? $4,000, right? So if you remove $500 from this pay after tax, then it remains as $4,000, right? Now you see the difference. Everything is same. Employee's monthly gross is same. It's the same employee basically. Okay. Now see if he or she opts for traditional, then how much is the net pay? And if he or she opts for Roth, then how much is the net pay? So this is the core difference between the traditional and the Roth version of these two type of plans. Okay. Now there are more differences. There are more core differences. One we saw pre-tax and post-tax. Another key difference is that in case of traditional, the withdrawals are taxed at retirement. Now you saw the cons here, right? In case of traditional. So employee was getting more net pay, but they will be taxed when they withdraw this fund after their retirement, if they have gone for traditional plan. Whereas in case of Roth, the withdrawals are tax free at the time of requirement. Okay. Now it really depends on individual needs. Okay. Some people might think that no, I don't want I don't care if the amount is taxed at the time of retirement. I just want my take home salary to be higher, right? So they would go for traditional. And if, let's say, they don't care about the take home salary, they want their the funds to not be taxed at the time of retirement, then they would go for Roth. Okay, there are more pros and cons in both of these type of plans. Okay, I'm just telling you the main differences, the core differences. Okay, now, so we saw the structure of the plans, the different category of plans. Right now we'll see how do they work, right? So let's say that there is an employer opens a retirement account. Now, depending upon the sector of the employer, I mean, depending upon which sector this employee works in, a retirement account is open for the employee by the employer, right? Now, let's say employee opts to contribute 6% of his or her gross pay, and which comes out as $300. Okay, so then what will happen that employer will also match employee's contribution. Okay, so let's say employee is contributing 6% of his gross pay, which comes out as $300. So basically employer will match employee's contribution. That means 50% of employee contribution. Okay, so what is 50% of employee contribution? Employee contribution is $300, so 50% of that is $150. So basically employer is matching the employee's contribution, right? So another $150 from the employer is going to this account. So total how much is going? $450 each month. Okay, so this is how this retirement plan works fundamentally. Right now we'll dig more into now another thing which I just also covered that. So this contribution will happen over the period of time. Every pay period, the payroll will be run, the reduction will happen, the contribution from both employee and employer will occur, and this account will start accumulating the funds over the years, right? Now, while that happens, I'm sorry. So this actually contribution is also called the matching contribution. Okay, so what employer contributes towards this fund is called matching contribution, because employer is matching the employee's contribution. Okay, so now over the period of time, as the fund grows and while this happens, employee can actually invest the fund from this account to other options. They have an option to invest it further, to grow it further, to grow it more if they want. Okay, so they can invest on mutual funds, bonds, or stock options. Okay, now this responsibility of choosing the investment options entirely goes on to employee's shoulder. Employer, they don't actually decide which of these funds, which of these investment options this fund should go to. The next thing is how employer matches the contribution, right? Now for that, I have actually worked on an Excel. So I have actually prepared this example to make it a lot easier for you. So we are talking about how the employer matches the contribution, right? Now there can be different type of matches: the percentage based match, the flat amount based match, right? These are the two main types that are used widely. There is another one, federal poverty line, but we'll talk about these two. So now how the employer matches the contribution. I told you in brief that employer matches uh, how much employee contributes, right? A certain percentage of how employee contributes. Let's say we have this 2020-21 fiscal year. In US we have July to June fiscal year, right? So July 2020 to June 2021, right? Now employee has this gross pay for each month, right? It varies in some month, because there can be bonus payment, there can be some allowance or something, right? So in some months the gross pay varies. Now, the employee has decided to contribute 8% of his or her gross pay. Okay. Employer has decided to actually contribute or to match based on the percentage, and that percentage is 50. Okay. So employer will be matching up to 50% of employee contribution. So first, let's see employee contribution. How much is the employee contribution that is coming? Basically 8% of these gross pay. So it is coming down to as these amounts. Okay, for each month it is coming this much. Okay, and for employer contribution is actually employer is matching up 50% of employee contribution. So for each of these deduction or for each of these employee contributions, employer will be contributing 50%. So for 400 it will be 200, right? And so on. Okay, in some months it is 488 for employees, so it is going up to 244 for employer, right? And the total for the whole year is 4864 and 2432 for employer. So total is coming down to as 7296. The total contribution is coming to 7296. There is something called annual limit. Now there is a limit up to there is a limit that employee can contribute up to that amount only. Okay, they cannot go beyond that. So employees, the limit 2021 limit for employees is 19,500, and the total combined limit is 58,000, which means that in this example, this employee is contributing for the whole year 4,864, and the limit is 19,500, right? So it is still a huge gap, right? So actually, this limit works for the people who are getting much higher salary. Okay. So let's say if someone is having a monthly income as to $12,000, right? And they want to contribute, let's say, up to 15%, 15% of their monthly gross towards their retirement account. So now it is crossing the limit, right? It is going beyond the limit. The limit is 19,500, but as per this calculation, it is going to 21,600. So what will happen if employee, let's say, chooses to still do 15% when their monthly salary is, let's say, 12,000? So what will system do? So the deduction will start happening, right? As soon as it reaches the limit, let's say now we are at 12,600 and 14,400 and then 16,200 and then 18,000. So now 18,000 is actually and then next one is 19,800, right? So limit is crossed. So system will then stop the deduction from that point onwards as soon as it reaches the limit. Okay. Now here you see 18,000 and the next one is it crosses the limit, but employer contribution might go on until the limit is reached. Okay. So this is how it works. So in your payroll, at some point of time, if the limit is reached, then after that the deduction stops happening. Okay. Now there is another type which we define and which exists. Now this is a very simple one, that employer is matching up to certain percentage of employee contribution. But it can also happen that you see additional row is now added here, that employer matches up to the 50% of employees contribution, up to 50% of employee contribution, employer matches the 50%. It is a bit confusing, right? And for the remaining employee contribution, employer is actually matching the 100%. Okay. So let's say that for this month, employees contribution is $400, right? Now this statement says that employer percentage up to 50% of employee contribution is how much? 50%, which means that the first 50% of employee contribution will be matched as 50% by employer. So the 50% of 400 is 200. So from that 200, employer is paying 50%, and the 50% of 200 is how much? $100, right? Now for the remaining 200, employer is matching the 100%, which is again 200. So 100 plus 200 is $300. So this type of scenarios also exist where employer matches up to a certain limit. Employer matches, let's say 50%, and for the remaining it matches 100%. It can change also. It can say that up to 50% of employee contribution I will match, or the employer will match 60%, and for the remainder it will match 80%. The 50% and 100% numbers are not fixed. I mean, it all depends on the employer as to how much they decide. But the concept you must know, right? And similarly in this case also, that here employer can decide to actually match 60% of employees contribution. Okay, so according to that, this will change here, that the total contribution will change. Okay, so the next is the flat amount, the flat amount type of match, right? So in this, the ER will contribute, the percentage of ER contribution will be a flat amount, which is $250. So let's say employer says that regardless of how much employee is contributing, we will contribute this much, $250 for this employee each month. Okay, so that really doesn't have any connection with the employee contribution. It's independent, right? So it's a flat amount type of contribution. It is simple. Okay. Now there is another important thing which is called catch-up contribution. Okay. Now what is catch-up contribution? So now this limit here, the 9,500 individually and 58,000 overall, is for the employees when they are less than 50 years old. Okay. But as soon as they reach 50 years of their age and more, they get additional, the limit is actually extended a bit. This limit, this 19,500 limit is actually extended by 6,500. So they get additional limit, actually 6,500. Okay, when they reach the age of 50. So what does it mean? That let's say initially they had decided to contribute, let's say 8% when they were less than 50 years of old. Okay, in this section we're talking about this section. They wanted to contribute 8%, where employer match type was percentage and employer was matching 50% of their contribution. But let's say now the employee has reached the age of 50. Okay, now as soon as the employee reaches the age of 50, their limit is actually extended by 6,500. So the total limit for individual employee becomes how much? It is how much? I think 25,000. So the individual contribution limit for employee has now become $26,000. But employee is still contributing 8. Now the employee feels that since their limit has been lifted and it has now become more, so why shouldn't they contribute more, right? Because if they can contribute more, they should be able to, right? Now in that case, they can actually do a catch-up contribution, which means they can contribute additional 3% of their gross pay. So they say, they go back to the employers and ask them that I want to contribute 3% more towards my monthly 401k contribution, and that additional contribution is called a catch-up contribution. They are simply catching up because the limit has been extended. Okay, so this is called catch-up contribution. So now for this catch-up contribution, again employer might want to match, right? So what is the ER match for catch-up? Now these terms can be a little bit confusing, but if you understand in this way. So now for this additional catch-up contribution, employer also might want to say that, okay, since you are putting 3% more towards your 401k account, so we also would like to do a little bit more, and we also want to match your 60% of your catch-up contribution. Okay. So now the 60% of employer contribution will be calculated on this amount, on the employee catch-up contribution. Okay. So let's say employee catch-up contribution now has become $150 the employees catch-up contribution is 3% of their gross pay, so 3% is coming down to $150, and an employer is actually matching 60% of employee contribution, which is coming in the month of July. It is coming as $90, and in some of the month it is coming more. Okay. So we talked about how employer matches the contribution. Now, finally, now you saw what different type of plans are, how do they work, what is the contribution, how the contributions, different type of contributions work. Now, how these different plans are, how they differ, how these number of plans differ from each other. So now there can be more differences from one plan to other plan. You have 401k, Roth 401k, 403b, Roth 403b. Now the differences can be in terms of their annual limit, though for now, for 2021, the annual limit for 401k, for 403 and 457 is same, but it can also vary. So the annual limit for these plans can be different. Annual limit total can be different, annual limit for employee and the total. The catch-up limit can be different or can be the same. The tax deduction type is obviously different, as you have seen, right? Pre-tax and post-tax. There can be investment options which can be more in one plan and can be less in another plan. Okay, so for instance, in 401k, traditional 401k, there are less investment options, and in the Roth 401k, there are more investment options. Okay, likewise in 403b, there can be less, and in Roth 403b, there can be more, right? Withdrawal limit. So there can be different withdrawal limit for all these plans. Some of them can levy taxes at the time of withdrawal. Some of them will be tax free at the time of withdrawal, and there can be other differences. Okay. So these are the points on which there can be differences across all these plans. Otherwise, how they work, how they are structured, everything is same. Okay.
Subscribe HCM Simplified and hit the bell icon. Hit like if the video was informative.